Good evening to everyone who is attending live and also to those of you who are watching on the recording. Tonight we are presenting The Landing at Pinewood Park, a 238 unit C-class value add opportunity in Lubbock, Texas. For those of you that don't know me, I am Rick Martin from Fortress Federation Investments. We syndicate multifamily properties focusing primarily in the Southeast and Texas. As mentioned, tonight we are presenting The Landing at Pinewood Park, and there are a few things about this deal that get me really charged up. First and foremost is the operating team. I will be handing things over to a member of that team here shortly, but they are highly experienced and extremely competent, and that brings me great peace of mind. Number two, the fundamentals of the market and the deal. The market itself, the population growth is spiking upward in Lubbock and is expected to grow an additional 7% through 2022, which is pretty incredible. The job growth is projected to increase 40% in the next 10 years, which is well above the US average of 33%. I also like how education and medical are the two main economic drivers of the economy. As far as the fundamentals of the deal, they're great. It was purchased for $46K a unit, while comps are now trading in the 60s, and the property was recently appraised at $1.3 million above the purchase price. So there's equity going into this deal. And for investors, individually, I think it's awesome that they're going to cash flow from day one, and we're going to look to return investor capital by year three, which in the world of syndication is pretty quick. And one more thing I wanted to mention is a wise old syndicator once told me, if you can have a 1-to-1 ratio between median household income and the price per door, you have a great deal on your hands. And the median household income in the submarket is $44,000, while the price per door, as mentioned, we purchased for a hair under $46,000 per door. So darn near 1-to-1. Tonight we have Mr. Rob Beardsley from Lone Star Capital, who brought us this deal. Rob oversees acquisitions and capital markets for the firm and has acquired over 100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions, of which I have a copy, by the way. If you don't have it, pick yourself up a copy. It's a great book. He has written over 50 articles about underwriting deal structures and capital markets and hosts the Capital Spotlight podcast. So Rob and his team are highly competent in the space, as I mentioned. Now, unfortunately, we had a little glitch just as I was handing things over. So we're actually joining Rob mid-sentence, but still very, very early in this presentation. So take it away, Rob.
And, generally good meat on the bone. And like I said, we've been very successful with finding and executing on these opportunities. For example, we purchased properties that have been 50% occupied, 70% occupied, and 80% occupied, and have taken all of those properties into the 90% plus occupancy range, stabilizing their operations while reducing expenses, renovating interiors, and raising rents, and then ultimately refinancing the property at a much higher valuation to cash out, to return cash back to investors. So this property is right in our wheelhouse from that perspective. It is, again, another good, solid workforce housing property with good bones, built in the 70s. It was owned by a long-term owner who bought the deal 20 years ago, and I don't know what his price was, but I'm sure he bought it real cheap and has just been milking the cash flow and really neglecting putting money back into the deal, which has resulted to it being in its current state where it is, which is lagging the market from an occupancy perspective and being one of the lowest, having some of the lowest rents in the market as well. So we identified this opportunity, and this is a bit more of a unique story. As Rick alluded to, we actually purchased this property back in January of last year with a joint venture partner who, initially they were supposed to fully fund the property and the CapEx, and they didn't fulfill that part of their partnership due to internal reasons. They had a family death, and then COVID hit. And so COVID was the big factor for them pivoting away from this business and really not wanting to be involved. And so we've elected to buy them out rather than just going for a market sale. That way we have the opportunity to fully realize our business plan here, as we've thus far been spending money and implementing our business plan just out of the cash flow that the property produces itself. So we're really excited to finally go full on with our business plan. At this point, we've owned the property for a year. We know where the bodies are buried. We understand and have refined the business plan. And we've never been this prepared, obviously having this much time to prepare. We've got our business plan and CapEx fully scoped and bidded. So there's really no risk or potential for certain projects to be uncovered that we're not already identified, as well as the cost of those projects being already baked with our contractors. So taking a step back and talking about the market itself, like we said, this is Lubbock, Texas. It's about a 300,000 population town. It's I believe the 10th or 11th largest city in Texas, and it's home to Texas Tech, which is what it might be best known for. Texas Tech is a huge university. I think they're approaching 40,000 undergrad, and I think with graduates, they're up to 60,000 or so. So it's a major driver of the market, and the other major drivers being agriculture and healthcare. And so those are very recession resilient and diversified employment bases. And Lubbock has proven its diversity and resilience in employment by actually maintaining strong employment figures through COVID. And actually rents have risen 2.5% through the past year during COVID, and occupancies have risen 1% as well, which is very impressive. While obviously national averages rents have dropped, occupancies have fallen. So that's something that we really like about this market. Previously Lubbock and similar secondary cities in Texas have been viewed as more of steady Eddie markets where you can buy in at a high cap rate, get good cash flow, but not really see much appreciation. And we've really seen that change actually now that, really the whole country is migrating to these states like Texas, where there's no state income tax, business friendly and lower cost of living. And so while a lot of the headlines are highlighting Dallas, Fort Worth, and Austin, Houston, the secondary markets are beneficiaries as well. And there's plenty of people that are from those big cities moving out into the smaller cities like Lubbock. And that's, basically that rising tide is lifting all ships. And we're seeing a market like Lubbock, like I said, which was previously kind of a high cap rate, steady Eddie market, now is more of a growth market and has the low cap rates to match. And so, for example, we're seeing cap rates in the threes even, and certainly in the fours in DFW. So investors are moving out to markets like Lubbock and being willing to pay 5% cap rates for for value add opportunities here. So we've seen prices rise substantially, and as Rick mentioned, our appraisal at this point in time has come in 1.3 million above our purchase price. So new investors coming into this deal are locking in instant equity. And like I said, we're really excited to actually go in and bring this property up to its full potential, which we feel we'll be able to sell the property in the mid to high 60,000s per unit, which is obviously a major premium to our going in basis. So drilling into the submarket specifically, this property sits on the corner of two main streets, in a really class B plus area, really clean area. So we love this kind of deal. I think everyone loves the cliche, class C property in a B area or a class B property in an A area. And that's exactly what we have here. We have comps just, across the street behind us that prove out our business plan and actually leave some headroom in terms of rents. We'll look at the rent comps soon, where you see our modest renovations aren't targeting to become the top of the market. We still want to keep this as a affordable workforce housing asset, but just bring the rents up to market to be in the middle of the pack. And obviously the occupancy push is really the main value add driver. Currently the property sits in the low 80% occupancy. We've actually already seen some leasing pickup, and we anticipate to hit 90% in about 2 weeks or a month. On top of that rising occupancy, we have some other really low hanging fruit. We've got some, like I said, accumulated deferred maintenance from the previous long-term owner that we haven't been able to get around to due to a lack of capital. The biggest project is the roofs. Um, about half the roofs need full replacement. Some of the roofs just need repairs, but some of the roof issues have resulted in active roof leaks in about 15 of the units, which means we are not currently marketing those units for rent, because it would just be, I think Rick, you said cruel to move someone in to a unit that has active roof leaks. And of course that would just not end well. So anyway, that's super low hanging fruit. We fix the roofs, we turn those units, put a nice make ready, fix whatever's broken. We don't have to put in stainless steel or granite appliances. We just need to have clean, um, clean floors, countertops, and black appliances. And then we'll be able to quickly bring another 15 units online, pushing our occupancy above 90%. So, it's not while the returns somewhat imply a heavy repositioning effort, we really see this as a pretty straightforward process and low hanging fruit. And I think something to appreciate is investors generally have a harder time understanding or buying into a business plan where you're raising occupancy because it's less visual. Whereas renovating interiors is very visual. You have a before picture and then you have an after picture of an old kitchen and then a new kitchen with, the bright stainless steel and granite countertops. So this is a bit of a different business plan, but we've had success identifying these sorts of lagging properties. For example, one of the properties I mentioned before, we purchased at 80% occupancy. It was a fully renovated property. And, most investors looking at that asset would think, well, it's already renovated. It's at 80%. That just must be the market, or that just must be the property's problem. Nothing you can do. And so because we saw something different and we underwrote the property, we looked at the comps. I personally walked all the comps in that market and identified what the competition was operating at in terms of occupancy, what they were charging for rents, and what the quality of their product was. We felt the confidence to actually buy that property, spend very little on the interiors. All we did was throw in some backsplashes in the kitchens to bring a little pop. And we were able to actually take that 80% occupied property up to 100% occupancy. So that's more of an operational play, marketing effort. And those can be just as profitable, if not more profitable, because you're actually not spending as much CapEx to yield your return. So another interesting factor to understand about this deal is the debt. So the debt is a loan assumption of an existing Fannie Mae loan that was put on the property in May of 2016 by the previous owner. And at this point, the loan is, 5 years into its life. The loan matures in May of 2026, which does align perfectly with a 5-year hold. But like Rick mentioned, we really want to implement this business plan quickly and then refinance or sell the asset somewhere around the 3-year mark or less. And we'll talk about the prepayment penalty associated with doing so. But the economics are there to support it, because the new increased value will be able to cover the prepayment penalty and still achieve high returns. But this existing loan at this point has run out of its interest only period. It's amortizing. So we are currently paying interest and principal on a 4.8% interest rate, which is obviously above market. So the fact that this property is cash flowing in its current condition and paying down principal really speaks to the downside protection and, the low risk of this deal. Another low risk marker of this deal is the fact that the debt is somewhere around 60% loan to value here. So typically when we buy one of these turnaround plays, we buy with a bridge loan, and a bridge loan is high leverage at 80% loan to cost and is more expensive. In this case, we have a low leverage in place loan with 5 years of term left. So there's not really a ticking clock on us to get in and get out. So that's really great. I think that's a unique opportunity to have a mismatch between, high return potential business plan, but low risk debt, because often you don't have both of those. So, but obviously the downside there is that we don't have optimal leverage. And so we have to bring more equity to the table here to execute the deal, which typically is dilutive to returns. Obviously, leverage magnifies returns. So I think if you kind of study the numbers, you'll be really impressed to see that the unlevered return of this deal, the unlevered IRR, is, I believe, somewhere around 13.6%, which is a tremendously high unlevered IRR. And so the leverage, being that it's modest, only magnifies the return up to somewhere around 17% net to investors after all fees. So that is that's the next that's the next wrinkle there that's important to understand. So again, the current debt is paying principal and interest, which is very unique because 99% of the time you buy a deal, you go in with some period of interest only on the debt. And obviously interest only is great because you're only paying interest, and that provides more cash flow for the initial years. So in this case, we don't have that, but which means worse cash flows. But on the other hand, it's great because it proves the downside protection. And every single month, we're building up equity as we're paying down the debt. So let's talk about the investment structure. So you've learned about the debt. Now let's talk about the equity. So on the equity side, we've structured this as a pretty industry standard promote and preferred return structure. So investors receive an 8% preferred return, and we make monthly distributions. We anticipate starting distributions in June, and distributions are going to start modestly, somewhere around 2%, and they're going to ramp up throughout the first year of ownership up to the goal being 8% plus, which is meeting and exceeding the preferred return. So the priority of payments, and again, the preferred return is cumulative and compounding. So any payments that are not paid in a certain period accrue to the following period and are compounded. So if you're not getting paid your 8%, the 8% that you weren't paid is earning 8% on that. So it's got that function to it. So the next thing that is unique about us that you don't see very often in syndication structures is that we actually run an IRR hurdle, which is standard in the institutional space. But this is an added layer of protection for investors, by which investors receive 100% of their originally invested capital back and their preferred return before any performance compensation kicks in. So this is really great. And I think this aligns interest really well. And it's actually, while it may be new to some folks, it actually is very intuitive. It's very easy for me to tell you, look, you're going to get an 8% IRR, which includes your, obviously an 8% return on your investment plus all your money back. And then we're going to split the cash flows 70-30 thereafter. So what that means is, realistically, all the cash flow generated by the property is going to go 100% to investors. Obviously, it would be difficult for us to return all your capital just through cash flow. It is possible through a refi, but most likely to occur through a sale. So in a sale scenario, assuming that the 8% preferred return has been paid and current throughout the investment period, then upon a sale, the priority of distribution would be first, investors receiving all their money back, and then the profits being split 70-30. The acquisition fee is a 1% fee based on the purchase price, and the asset management fee is, again, a standard 2% on revenue uncollected revenue. And here below, we have a hypothetical or example $100,000 investment achieving just over a 2x equity multiple. And what that means is simply invest $100,000 today, and you should double your money in roughly 5 years. So I talked about the property already a bit, but now we'll highlight more about the business plan. So I mentioned the roofs before. Here you have a picture at night of the pool, maybe not looking so attractive, but that's all in the plan. We really want to focus on curb appeal, and that includes landscaping, signage. As you can see on the picture on the right, it has that sign there, but it doesn't really pop and doesn't it doesn't catch your eye. And this is a very busy road, and we want to take advantage of that. So adding more signage across on both of the streets that it has frontage on, it has plenty of frontage. It's a large property, will help to attract more interest and walk by traffic, drive by traffic. Cleaning up the landscaping, and we're going to power wash all the buildings. You could make an argument for painting the buildings, But again, we feel that this is a low basis workforce housing product, and we think that it would be potentially overspending to go for the full paint job rather than just a nice clean power wash. So we've got $1 million capex budget, but we're spending it strategically and wisely based on our market intelligence and where we think we'll get the maximum ROI. Some other ways to enhance curb appeal and leasing activity is through amenities. If you've ever gone on a property tour before, or you're looking at a potential property, you know that as a renter, you're very attracted to the amenities and something like a gym, for example. But at the end of the day, nobody really uses them, or not. They don't get used as much as people think, but it does attract and does very well as a leasing tool. So this property, even though it's a classic large multifamily complex, it lacks those key amenities that you come to expect on a large property like this, including a fitness center, business center, kind of a gazebo area, or picnic tables and whatnot. So we're including all of those. Just off of the pool, there's going to be we've cleared out space in the clubhouse or the office for a fitness center. We've also cleared out a back room for a business center, and we think those types, and adding gas grills and picnic tables near the pool, and we think those things are going to help drive leasing and be more successful when our leasing agents are doing property tours. Here you can see an overhead shot of the two busy streets, 4th Street and Slide, right there on the corner where the McDonald's is. This is like I said, a B plus area. You're very proximate to all the, everything that Lubbock has to offer. You're 2 miles away from the school, so plenty of residents work at retail and service jobs related to the university. And then there's obviously Walgreens across the street. The Walmart is just a couple miles away, which employs a lot of people. And then the two healthcare main centers are also within just a few miles. So here you get a sense of what our upgrades look like. Again, we're not taking this up to stainless steel and trying to shoot for a $200 rent premium. We're just going for a modest $50 rent increase, which is absolutely available and proven in the market. We're really looking to close the gap that exists between this property and the market, rather than taking something that is already operating at market levels and then trying to, blaze a new high. Another thing that I just reminded myself of is the cable. So this property provides cable and internet to all the units, and the previous owner was not charging an upcharge for this. And so we have recently on new leases implemented roughly a $45 upcharge, and it's being well received, which is great, because that's essentially, in addition to our $50 rent increase, we're capturing another $45 other income increase, and that's really driving the returns. So here's just unit mix. We don't have to cover everything, but you've got predominantly 2 bedrooms. And here you can see the rent increases going from about $702 to $754. And again, our pro forma rents on a per foot basis are just 86 cents. So we'll jump to the rent comps, and you'll see so you see our average of 86 cents is proven out by the market. We're sitting, our renovated and pro forma rents are going to sit somewhere in the middle of the pack for the market. And also the comps in our area are in the mid 90% occupancy as well. We, in spite of our confidence in being able to raise the occupancy up into the mid 90s, we've underwritten just a 92% occupancy factor, which we obviously plan to overshoot, but I think that's conservative and, makes sense. Obviously not trying to stretch the numbers in every way possible on the deal. Now the sales comps is what gets, us really excited. We're a buyer, and we look at deals that trade in the market, in Lubbock in particular. And, for example, on Courtyards on the Park, we were a bidder on that deal. We lost out to someone who came in with a very strong offer at 64,000 per door. That's a 103 unit property built in 63. It's a far inferior property to the landing, our subject property. And so that just again proves out the value, and that's also a value add deal. And then another portfolio we bid on was the LSQ portfolio, and that was, I mean, that deal actually was very rough. I toured those properties. It had down units. I mean, talking about, $15,000, $20,000 per unit repairs in some of those units, and some of them were, very small units as well. And that's incredibly, that portfolio sold for 63,000 per unit. So we're seeing proven trades happen today that prove out our exit price 5 years from now. So we don't even need any appreciation, which we think the Lubbock market will deliver to achieve our returns. So that's the really exciting part about this deal, in my opinion. So this is just detailing our $1 million budget, as I mentioned before, kind of already gone into it. Pro forma, some sensitivities. But yeah, I think I'm pretty much wrapping it up there. Let's absolutely dive into some Q&A.
Hey, Rob, did you mention the fact that you're restoring the basketball court into a playground?
No, I didn't.
You did, yeah. I think that's a nice touch that you guys are adding to the beginning.
Yeah, that was the amenity I missed, and that basketball court sits in the front of the property. It's one of the first things you see when you drive in off Slide, and right now it just looks, ratty and unattractive. And so definitely a playground is going to be more used by the residents and be more attractive from a curb appeal leasing standpoint.
Yeah. And while you're not painting the place, you are pressure washing the entire place, and you're repainting the trim. So I think it is it's gonna liven up the curb appeal. Anybody that has a question, please put it in the chat box. I have a few questions that were submitted earlier that I can begin on. But if you have any questions, go ahead and put it in the chat, or I can unmute you if you prefer. Just let me know in the chat. Let me pull up these questions that I had. I got a message, by the way, at the beginning wasn't recording, so my lovely intro I think got cut off. But don't worry, Rob, you're 100% covered. Okay, are there any natural disaster threats? And if so, are they covered by the insurance?
So this property does not sit in a floodplain, so there's not real flood risk, generally speaking, in Lubbock. So we don't have flood insurance. The biggest threat from a natural disaster standpoint is for this market is hail. Mm-hmm. And hail is covered. And so what people do in places like Dallas and Lubbock, where there's lots of hail, is they don't typically do major roof replacements unless they get major hail damage. Unfortunately, we're not getting to benefit from that at this point, but that is covered in your insurance. So the answer is hail, and it is covered by insurance.
Okay, cool. Any idea why the former owner sold?
So the former owner, like I said, was actually a local guy in Lubbock, owned property for years, owned this property for 20 years. And he, he's old, and he was passing down his portfolio to his sons, but his sons were not interested. They didn't feel that workforce housing was sexy enough, so they ran off to the four corners of the country to do new development. And so that left the father to sell off the older assets rather than passing them down.
Okay. We got a question here from Ed. May have missed this. Are there additional streams of income planned? Parking places, covered parking, trash removal for dumpsters, rubs. Can you speak to that?
Yeah. So the one that I touched on was the cable fee. That's the biggest additional income driver. The other things is we are going to test out the demand for reserved parking, and we're not planning on doing any valet trash, which is where someone comes to your door and takes your trash to the dumpster for you. Um, Typically, you see that be more successful in a more B class tenant profile. But yeah, definitely continuing to push on the percentage of rubs that we build back as well will help drive other income.
Okay. This from Travis, and I know the answer to this, but I'll let you answer. Will there be a cost segregation, and will there be a K1 at year end?
Yeah, thanks for that question. So absolutely, we will be doing a cost seg report. For those that aren't familiar what that is, a cost segregation study is done by an expert who comes out and essentially scopes out the building for and identifies the age or the effective use of every type of property, from the parking lots to the appliances to the roofs, and then they're able to identify 5-year and 15-year property, and then through bonus depreciation we're able to capture those losses that you would capture over 5 and 15 years for the life of those items. You can actually capture in the first year of ownership. So we'll be able to capture bonus depreciation in this new first year of ownership. And the first K1 that you will get represent for your 2021 ownership will show a very large loss because of that cost seg plus bonus depreciation.
Okay. And this from Andrew. Are there any rental concessions or move-in specials offered at this property or at the comps?
So we have had some concessions like a half month free or a $250 move in and things like that. And those are mostly seasonal. In the summer, it's a hot time for leasing. Concessions, burn off, and then in the winter, they come back a bit. So uh, all of that is factored into our numbers and is, it's accounted for.
Okay. You kind of touched on this. I mean, you basically touched on this. What are the exit strategies for the deal? I mean,
Yeah. So So we underwrote this thing to a 5-year hold. I think that makes it the most conservative scenario that that we feel would occur, which would be just a plain 5-year hold, no refis or anything like that, and then we would simply just sell it after 5 years, and that's what the returns are based on. But in reality, there's going to be a lot of value in this property quickly created, and there already is existing value in it today. And so monetizing that value sooner rather than later will benefit the partnership. And so we can do that obviously through a sale or a refi. And in either scenario, we will face the prepayment penalty, which is yield maintenance. And so yield maintenance is calculated based on the amount of term you have remaining in the loan and what prevailing interest rates are at that time. And so the prepayment penalty that we underwrote in 3 years, if we were to sell in 3 years, is about 575,000, which is obviously a hefty number. But the time value of money and the value that we have created would compensate for that if we wanted to exit early, for those reasons. So what I like obviously I hate yield maintenance, but what I like about this business plan and the fact that we have an opportunity to exit early or hold to maturity, which is May of 2026, is the fact that if for whatever reason, values decline in the market, or if it takes a long time for us to implement the business plan, every day that we wait, the prepayment penalty goes down. So it's like a hedge. The sooner that we can get in and get out, well, we can create great returns, but we have to pay a larger prepayment penalty. The longer we wait, the returns are more, they're spread out over a longer period of time, still great equity multiple, but also the prepayment penalty, again, goes down to zero towards the end of year 5.
okay, cool. Well explained. Is there on-site management team office?
Yes, absolutely. So we have over the course of our just over 1 year period of ownership, we have finally gotten a great team in place. One of the challenges, admittedly, of a smaller market like this, in comparison to a large market like Houston or Dallas, is the talent pool is worse for your on-site employees. And so we've worked really hard to recruit and bring in a very quality property manager who actually was formerly a regional manager. So she is, essentially overqualified for the position. She knows the property well, knows the area very well, and she's proving to be a very great on-site asset as the property manager. And then we've got our assistant manager, leasing agent on site. So those three in the office. And then we've got a team, our maintenance team, who are handling work requests and things like that. And so, uh, it's been far from perfect, inheriting the previous ownership's on-site staff and then having some people leave as well and having turnover. And so we're, essentially just now getting that team solidified and looking forward to moving forward with both, a strong team and being well capitalized to implement the business plan.
Okay. Will you and your partners be putting your own money into this deal?
Yes. So the two principals of Lone Star, Kent and myself, are investing $200,000 in total.
Yeah, and I'm going to be investing myself as well. I touched on it earlier, and I'm afraid I got cut off, but there are three things you look at a deal. Number one, you look at the team, and these guys are extremely confident. If I do say so myself, Rob, and they know their numbers, they know how to execute, and they have a track record. The second thing you look at is it the market itself, and you just got to check what's going on in Lubbock. The fact that it's growing 7% in the next year is pretty insane. If you look over 20 years, maybe it's not that impressive, but what you want to look at is how it's ramping up in the last couple of years, and it's projected to increase even further. So the market's strong. We talked about the job projections, and then the deal itself, it just has really strong fundamentals. That's what attracted me to the deal. I talked about the median income. It's in that perfect pocket, and how it actually matches the price per door. And for the single family rental people, it definitely surpasses the 1% rule. So it's got a lot of good things going on for it in that regard. And then we talked about how the price per door compares to the comps in the area. So that's a long-winded way of saying I'm invested in this deal as well. We've got another question from Ryan. When is the purchase date of this property? Good question.
Is Ryan asking about the closing date?
Yeah. Can you clarify, Ryan? Is that closing or purchase?
So we're anticipating closing the property on April 15th.
Mm-hmm. He says either.
Either. Yeah. So we're planning on closing the property on April 15th. And, we might, I don't think so, but we have the opportunity to execute an extension if need be, but the plan is to close on April 15th.
Okay. Yeah. And he says, when's the purchase date of this property? This sort of kind of goes into the story of the building, right?
Yeah. So like I said, the original owner bought this property some 20 years ago. We purchased the property from that longtime owner in January of 2020. So we've owned the property for just over a year.
Yeah. And that's also a nice thing. You often see properties that are retraded, within the last couple of years. This one, the last owner was, he bought it 20 years ago. So that's another good signal. Let's see if there are any other questions here. Going once. All right. Well, in the meantime, thanks again, everybody, for coming on. I know it's dinner time for some. It's time to go to bed for others. And we appreciate your time. The next steps would be, if you haven't already put your soft reserve in, put that in. And we'll move from soft reserve to official investment pretty quickly. In fact, I will put, since those of you who are on the call, I should reward you, but you have this in your email. Going to put the link to the soft reserve if you wish. And then also, if you want to contact me directly, you can reach out to me at rick@fortressfederation.com. And I can walk you through how the next steps work. And I think what we'll do is, hopefully this recording worked. We're going to send out a link tomorrow with the recording so you can rewatch this, go over some of the details. And as always, investments will be taken on a first come, first served basis. So in that link tomorrow, I'll have a link to how you can invest or where you can invest. You're going to register on Lone Star's portal, and we can walk you through that if you have any questions. So I think that about wraps it up. I don't think I see any other questions here. So thank you again for attending. We appreciate your time and looking forward to partnering with you.
Thank you so much.
Thanks, everyone.